Hello everybody, it's the Maverick Trader here, and today we are going to discuss about a topic that many people know about, but they do not understand it really well. And this topic we are going to discuss in such a manner that you're going to understand how to apply this in the real market. So the topic that we're going to discuss today is RSI. What is RSI? How is it used? And what are the terms involved in RSI, like bullish divergence, bearish divergence? So these are the things we are going to learn in today's video. So watch it properly and understand the concepts, and then backtest these concepts on the chart and see whether it actually works for you. Okay? Now I'll meet you in the video. So what is RSI? RSI is basically relative strength index. So it basically measures the strength of price at a particular point. It says how overbought or underbought a stock is. Like you can see in this diagram, it shows that there are two levels. One is 70 and one is 30, the 70% level and the 30% level. So once the price goes above 70%, it is considered as overbought. Okay, and it means that the share has been overbought, and that there are too many buyers and there are very few sellers. And it's usually at this point it's considered that it's better to sell the stock and book your profits. And when it goes below the 30% line, it is then when you know that the share is oversold, which means there's an excess of sellers and a deficit of buyers. And this is where you know that you have to start buying the stock, because after each of these points usually stocks tend to reverse. Okay, so what is RSI? RSI is basically a technical indicator that shows what is the strength of price at a particular point of time. So suppose if a stock has the same price on day one and day two, it doesn't necessarily mean that the RSI will be the same for both the days. The strength of the price can vary across those 2 days. Okay, so now I'll move on to explaining how RSI looks and how it works. So RSI has two important levels. One is this, that is a 70% level, and then is this, that is a 30% level. So above this, above the 70% line, the whole region is considered as overbought, which basically means that there's an excess of buyers in the market and there's a deficit of sellers in the market. And below this 30% line, if the RSI goes, it basically means that there is a excess of sellers in the market and there's a deficit of buyers in the market. So let's understand what significance do these things have on the movement of the stock. So once the RSI moves into the overbought zone, it basically means that now the sellers are going to come in, and this acts as a sell signal for traders. So usually people start selling in these areas, but there are other conditions that we have to take into consideration, which we will discuss later. And now if the RSI is below the 30% zone, it means that the stock is oversold. What does that mean? It means that this acts as a signal for traders to buy, because there's an excess of sellers and now buyers are going to come into the market, which will lead to the stock moving upwards. Okay, so now can you see the 30% line? Now when the RSI is below the 30% line, when it's at 25 or 22, and the stock, can you see it? It's such a huge red candle, and now can you see the price rebounding because it's been in the oversold zone. So now look how quickly the price has reversed from here. So what I'm trying to say is that RSI can be used as a tool to check when a particular stock or index price is going to reverse. Can you see here? It's been in the oversold zone. Wait a minute. Yeah, it's been in the oversold zone, and see, look how the price has rebounded and gone upwards, and again it's come back to the oversold zone, and again it has rebounded and gone up. Okay, so this is basically how RSI works. Okay, so what is a bullish divergence and what is a bearish divergence? So first I'll explain what is a bullish divergence. So bullish divergence is basically when the stock is making a lower low. Okay, can you see it's making a lower low, but the RSI is making a higher low. Can you see this? The RSI is moving higher, but the price has fallen down. So what does this mean? This means that the stock is going to bounce back up again because there's an increase in the strength of the stock in this particular region. That's why the price might be falling down, but see, even though the price is falling down, the RSI or the strength in that stock at that particular point is increasing, which means that there's going to be a bounce back. Okay, so what is a bearish divergence? I'll explain it to you now. So see, when the price makes a higher high, can you see it? Price is making a higher high, but the RSI is making a lower high. Can you see how the RSI is making a lower high here? Yeah. So this is considered a bearish sign. Why? Because the price is going higher, but the strength in the price is going on decreasing. So this is always a bearish signal. And can you see? It made a bearish engulfing candle here, and look at the immense fall that came. It's about it's about a 1.6% fall. That's 633-point fall in Bank Nifty, just based on the small simple indicator. So I hope you people understand what this is about. Okay, so I hope you people understood what RSI is through the charts and how to use RSI to make a buy or a sell trade, to buy a call or to buy a put, or if you're an option seller, to sell a call or sell a put. So before using this tactic, please backtest it on the charts, see whether it's actually working for you, and only if it's working for you, make a trade based on this. Okay, so I hope you people enjoyed this video. Thank you for watching and happy trading.